Hello everyone again, thanks for coming in on Saturday. Today we are going to discuss PP&E, property, plant and equipment, whatever fixed assets our business can have, and what to do with those fixed assets in accounting. And let me start by sharing the lectures. These are MIT lectures. They are a bit old, 2004, but PP&E accounting didn't change much since then. And just in case, we will have our last module today about accounting guidance, which is modern, like the most up-to-date, and we will see, we will discuss where we can find the most recent accounting guides. Okay, so where we will start with that lecture is to understand how the matching principle influences the capitalization of long-lived assets and the expensing of capitalized costs to match revenues generated in the use of long-lived assets. The lecture also touches a bit about deferred taxes. We will not cover that today. It's kind of a bit complicated area to explain, and it might confuse a lot of people, including myself sometimes. I'm not a big tax guy. Some people specialize on that. I only have like a average knowledge of that, sufficient to do my work, not much than that. Okay, so let's see what we have here. Capitalize. What do we mean by capitalizing the costs? It means that we will show that assets on the balance sheet, so that assets have future benefits, and the opposite of capitalization of costs is the expensing of costs, when benefits are immediate or future benefits are too uncertain, like research and development. Sorry, I got a bit of cold, so I'm not in a best shape to present today, but let's continue. So what does it mean? What does capitalization mean in terms of double entry, in terms of accounting entries? So if we go to our transaction list, we can find that we bought, for example, we acquired equipment for 10,000 K. Let's add here with an aim to use that equipment in our equipment to produce goods, services. Okay. So if we buy that equipment for resale, and if we are a reseller of equipment, we will put that equipment into our inventory account. But if we do that for production purposes, we capitalize it. We debit equipment account on our balance sheet. We do not debit expense account. And an example of the opposite. For example, we acquired an equipment for 2,000. And we have an accounting policy that we treat some equipment of 2,000 or less. Let me add here. As an expense. So in that case, we can write it off. But however, the accounting guidance on that stuff, there is a separate accounting GAAP guidance which says, dedicated exactly for that matter, which says that US GAAP doesn't permit the establishment of capitalization threshold. However, for the ease of record keeping, many reporting entities establish a capitalization threshold to specify the minimum amount of costs that must be incurred before such costs can be capitalized. And the assumption is why we can do that is when we can prove that any effect from such threshold will be immaterial. So let's add this comment here, just in case. Though capitalization so though it is not allowed under US GAAP, you can still do that if you believe that, if you can prove that the effect will be immaterial, insignificant. Let's see what's going on here. Okay, is sound okay? Is video quality okay? Okay, so let's go back to our lectures. So capitalization means that we put it on the balance sheet. Assets are consumed in future to generate future revenues. Current assets like inventory, prepaid rent, and insurance. Non-current assets like plant, buildings, machinery. Non-current intangible assets like patents. So some of these are current assets, and they usually are consumed within 1 year, within 12 months. And if it's not current, if it's more than 12 months, then it's like property, plant, and equipment, and intangible assets. So what do we need to know to account for non-current assets properly? We need to know the acquisition costs, expected useful service life, salvage value, and the pattern of depreciation. And they also have a note here that the land is the only non-current asset that is never depreciated, amortized. And we need all of that because actually an accounting standard requires us to have that. Let me share the guidance with you real quick. So it will be PP&D accounting guide PwC. Okay. So anyone can get this guide totally free, and I advise you to download it because from time to time they change their minds and they remove the guidance from the website, but later they upload it up. So I don't know if it will stay there. But there are also other Big Four guys from Ernst & Young, Deloitte, KPMG. Okay, so let's look into guidance. So there is quite a bit of changes, but they are mostly immaterial or they relate to like recent developments. They do not touch basics much. Okay. So basically what we see here is property, plant, and equipment consist of long-lived assets. Let's see if I can add some. Land and land improvements, buildings, machinery and equipment, furniture and fixtures. And usually long-lived assets means that they are more than 12 months. The useful life is more than 12 months. Sorry, I need to take a pause. I got a bit of a cold. Okay, we are back. And that's interesting that PP&D accounting standards, which is accounting standard codification 360, it doesn't include any specific guidance for capitalization of costs incurred during the development of self-constructing assets for a reporting entity own use. So we can acquire assets. Like if we buy a car, we just buy a car. It's just we purchased an assets for the cash. In some situations, we can do like a self-constructed assets when we have workers, when we have, of course, some contractors, and we spend time and money and resources of the company to construct that assets. And there is actually not much direct guidance in ASC 360. And I can remind you that accounting standard codification is called authoritative guidance. That means that it is like a primary guidance. And only if you do not have guidance in authoritative guidance, you can look for other places. And one of the places where we can look for that capitalization is a statement of position from the Financial Reporting Executive Committee of the AICPA, accounting for certain costs. So though there is no straightforward guidance, we can find guidance, as that relates only to self-constructed assets. So now let's see what guidance say accounting for capital projects. Let's see, do they have some lists? So basically they do not provide us with a concise statement to answer the questions. So what is the acquisition cost? So acquisition costs, to figure out what is an acquisition cost, you need to go to the guidance and find your situation, and then go through it like paragraph to paragraph and make sure that you classify everything correctly. What is expected useful service life? That will require your judgment. So you will need to figure it out on yourself. Usually big companies have like a policy. So for example, in our company, if we acquire a new truck, we usually say that its useful life is 5 years. If we acquire a used truck, we say that its useful life is 3 years. And we might call, so in some other industries, that useful life, okay, is it in guidance or in, I got a comment that text is bad. Let me see. Have you tried adjust the quality? Let me on my phone it's not that bad. In your YouTube you can have in the top right corner you can have a 3 dots, and if you click a 3 dots you can change the quality. I don't know, let me try to show it here. So this is my YouTube, and here I can adjust the quality. So this is my translation. But on your mobile phone, in the top right corner, you will have 3 dots around here. And if you click on those 3 dots, you will see quality. And you can try to adjust it to the maximum possible. It might also be the case with your internet connection. If you're trying to access the lecture from like not from Wi-Fi but from cellular internet, it might be a bit challenging in terms of quality. I tried it on my phone and it looks good enough on the phone. I can't tell you. Let me see. How? I don't think you will see that. So on my phone it's pretty good, I would say. Sorry for that technical pause, everyone. Let me just fix everything back. Okay, we are back in business. Okay, so what is the acquisition cost? We actually need to go to a standard to figure that out. What's the expected useful service life? We need to apply our judgment to determine that. What is the salvage value? Salvage value is if you expect to sell, if you expect your asset to have any value at the end of its useful life, you determine that based on its judgment. It might be scrap value. Frequently, people assign zero value to the assets. What pattern of depreciation should be used to allocate expense over useful life? Most of the time, a straight line depreciation is used. Sometimes you might use like a unit of production method. If you have a manufacturing equipment and you manufacture products on it and your volumes vary significantly year over year, like in one year you can manufacture 1,000, in the other year maybe 20,000, in the third year 5,000, in the fourth year 50,000. In that case, you might want to conclude that your equipment should be amortized based on production unit method, and depending on the usage of that equipment, you will calculate the depreciation. But let's go further. I believe we will have some advices about that. So to determine the acquisition cost, we need to understand what is given up to obtain the assets. So we include all the costs required to bring the assets into serviceable or usable condition and location. So not only purchase price, but also the cost to bring the assets into serviceable or usable condition and location. Purchased assets. Purchase price plus cost to prepare the assets for use. Installation, transport. Cash. Financing. Down payment plus loan note. As you might remember, in our practice exercises, so we have a building acquired with a mortgage, and we debited full value of the building, and we credited cash, and we credited mortgage. So for capitalization reasons, we put full value here. And let's see the second example. We have equipment acquired for 10,000. I will highlight it with different color. And we also we paid trucking company 2,000 for equipment transportation to this site. And we capitalize both of these costs, because this is a cost to bring an equipment to operating location and to put it into a productive state. To prepare the assets for use, purchase price plus cost to prepare the assets for use. For the practice, for the homework, I will add a bit of these questions: installation, transport, all of that. Self-constructed costs, direct costs of construction, financing costs, which we borrowed to finance construction. Okay, here we have an example. Let's see. Let's go to our transaction practice. We have quite a bit of an accounting entries done already. Let's copy our example. So we purchased new equipment. We paid 920K to vendor. We paid for transportation. We paid insurance for transportation. And we estimate that maintenance will cost 4,000 in the first year and will rise by about 20% annually. Okay, let's try to copy all of that into our practice file. Okay, so debit, property, plant and equipment. I'm taking the accounts from, so that will be just an equipment. Credit, credit, credit. Okay, vendor of the machine. Depending on the situation, whether we already pay these values, it will be cash. Cash. So 920,000, 62. I'm using just dollars, not probably I need to invest more money. Let's do 92,000, 62,000. Oh no. Okay. I'm trying to not put our company into the negative cash position. 10,000 will be just 100. So, and all of these are credits. So all of these are capitalizable expenses. We can an argument can be made about insurance. Let's see where it is. So an argument can truly be made about insurance, but that insurance is probably kind of required, and if it's not required, it might be reasonable, taking into account the value of the equipment, to insure it. Later, when we will go through the standard, we will try to find if the standard says anything specific about insurance during transportation. And maintenance costs, they are not capitalizable, especially the ones which you incur after you put equipment in the operation. And that's also determined by the standard. Example 2. Portland Products acquired a workstation. Pays 2,000 down payment to vendor. Signs 3-year not payable. Pays employees 5,500 to configure the work tests. Spends 12,000 to train the employees who will operate the workstation. Okay. So debit equipment. Okay, debit. So that is for down payment, and it will be, let's call it 2000. Cash. Sorry, it will be credit. Not payable. Let's see if I have any accounts for the notes. Accounts payable, mortgage. Okay, other long-term debt. Credit. Most of the time when we pay the employees to do something, that will reflect in our payroll expense. So I would say we first debit, we most likely credit payroll expense, but we will also need to make sure that let it be payroll expense product. And training is usually not capitalizable, but we will check onto that later. Let's see. Let's add it to Q&A. I'm more interested what are the arguments, how they argue about whether it is capitalizable or not. Okay, so other long-term debt, let's call it 18,000, and that will be 5,500, and cash was 2,000, and we got that. And now I will move it here, and I will do debit payroll expense, credit cash. So I reflect payroll expenses first, and then I will reflect that the amount was capitalized. That's usually how it happens in the accounting. So you record your salaries based on your procedure, and then at month end or year end you start to make reclasses related to capitalization. Let me do some highlighting here. This is how, and this is how. Okay. Let me see the timing. 10:45. Okay, so these are basically the entries which we do. So here they do not capitalize training, and we will look into that further. Myers is constructing a new production facility. Expected completion date is 6/2002. We spent 1.2 million for materials, 1.6 million to architects and laborers. Interest payable equal to 10%. Incurs fees related to zoning inspection, etc. And basically, what we have in that example, we have a capitalization of all of these items. So we capitalize material expenses, we capitalize direct costs of our assets construction. And as well, if we borrowed money to construct that assets, or if the standard says it in a way that if we have to incur any interest when we construct an asset, and that's basically in a situation when we have some general borrowings as well. So we have general borrowings, we construct an asset instead of repaying those borrowings, and we capitalize that costs. And the cost is capitalizable to your balance of that assets. The example here, it's kind of simplified, so it probably won't be the full amount of that interest which you will be able to capitalize. It will depend on how much and when you use those borrowings, and how long your construction was, and what were the balances. Okay. Salvage value requires managerial judgment, estimated proceeds at disposal, net of selling costs. So why do we need a salvage value? We need it to calculate depreciation. So your depreciation calculation will be acquisition cost less salvage value divided by your useful life, or your other pattern of depreciation. So you will depreciate only depreciable basis, not the acquisition cost. And depreciation basis is acquisition cost less salvage value. Useful life, again, it's your managerial judgment. It's the time period over which the asset will be used, and many factors can affect your estimate in that respect. So first of all, that will be what is the substance of that assets. If it's a car, it's one term. If it's a building, the other term. You also have like a tax requirements related to depreciable basis of different assets. You can think about developing your policy around that. But most of the time, it will be just your judgment. Your judgment, which most of the time you will use your judgment to develop a policy. If you buy and use many similar assets, you will need a policy at the end of the day. If you are a small business with just a few assets, you can use your judgment. And I remind you that this is all about accounting. Your tax depreciation will be determined based on the tax code, and it will be different from accounting. Depreciation methods. What does GAAP follow? Production method, we already discussed it, that we determine our depreciable basis, the amount we need to depreciate, and then we think about what useful life of our assets will be. It can be like based on machine hours of our equipment. So when we use machine hours, we will depreciate. If we don't use machine hours, we will not depreciate. We will not record an expense. Let's see. A machine with depreciation basis of 1,000 hours is expected to provide 20,000. During year 1, the machine used for 2,000. What is the depreciation expense for year 1? What is the machine book value at the end of year 1? Let me see. Do we have much left here? Okay. I hope we still have time for some practice. Okay. So how do we enter depreciation? Debit, credit. Let's see what depreciation account, depreciation expense, equipment. and then credit will go to accumulated depreciation equipment. We have all the calculations here. So first of all, I skip one transaction here, which is the acquisition of this 50,000 stuff. So I just record depreciation, then later we may record the acquisition of the item, or we can do it right now. Okay, debit, credit. Let's say we got all of the stuff on loan. Other long-term debt. Okay, 50,000 minus 50,000. So we got all the stuff on a debt, and then we depreciate 6,250. So that would be your entries for the depreciation of that equipment. And obviously your net book value of the equipment at the end is 43,750. Irina, could you please advise, did quality adjustment help you? I'm just wondering. I believe from what I see on my phone, though I have kind of relatively bigger screen, the picture quality is tolerable. It's not stellar, but it's readable even with my not that perfect sight. Okay, 50K. So that's when we depreciate based on production method, and we also have straight line. An example: Hertz acquires car for its rental fleet for 30,000 each. It expects to rent each car for 2 years, sells them for $15,000 each. What is the depreciation expense? What is the car's book value? Okay, and we basically have the same. We have the same entries here. Oh, not insurance expense. Sorry, that should be called different. Okay, so we acquired 30,000. We acquired the car and we depreciated the car. 7,500. 7,500. Okay. Depreciation expense 7,500. So as you see, we deduct liquidation costs, residual value from acquisition cost, and we determine that's 15,000 is the depreciation value, depreciation basis, and 2 years is their useful life, so they want to use cars only 2 years and then sell them for 7,500. So that's our depreciation expense. Okay, let's scroll down. So depreciation bookkeeping at the time of acquisition. So that's basically what we have just done. SV, salvage value. Yeah, I forgot the term. Salvage value, which can be residual value, or you can find a few definitions. So 15, in case of Hertz, when they sell the cars for 15, they expect to sell the car for 15,000. That is the salvage value. So you calculate depreciable basis. You calculate depreciation as a depreciation basis divided by useful life. Okay, here we have T accounts. I don't think we've already been through a lot of accounting entries. I don't think we need T accounts anymore, so I skip it. Accelerated depreciation. And accelerated depreciation is a term you will mostly see in tax accounting. And tax accounting in respect of depreciation allows you to depreciate your assets on a faster basis than straight line or than production method. And it allows you to recognize higher depreciation expense in the earlier years of an asset's useful life. Differences between tax depreciation and financial reporting depreciation expense gives rise to deferred tax account. So deferred taxes is something that exists. As you might know, there are differences between GAAP profits, between accounting profit, and between tax profit, and you are getting taxed on a tax profit. And accounting wants to present your tax expense consistently with accounting basis. And to do so, there is a concept of deferred taxes, deferred income tax expense, and deferred tax assets, and deferred tax liabilities. And that's a complicated matter, not for today. For today, we are done with this lecture. We will move to the next lecture. Let's see in the schedule if I have links. Yeah, I have links. A bit more exercises on property, plant, and equipment. Okay. And a link to the next stream here. Okay. Let me see what we've got here. So we will review changes in depreciation estimates, how they impact our accounting. Okay, so mostly we will deal with changes. Oh, we also got a disposal. Disposal is something we covered a bit in cash flow statements, but we will look on that into more details in foreign PP&D events. Okay, not everything in this lecture is applicable for today, but let's meet in a few minutes. Thank you.